Hotter inflation comes to spoil the rally party. 30 minutes until the start of your cash equity trade. I'm Danny Berger.
And I'm Yahaira Anand. Open interest starts right now. Nailed it.
Coming up on the show, stocks and bonds slip as fresh eco data adds to a sign of a cooling economy. And it's Nvidia's earnings day. Jensen Huang takes the spotlight later after the bell. Plus, a Bloomberg exclusive, Vanguard buys Altruist and a major push deeper into wealth management. Those conversations to come on the show. But first, I want to show you what some of these equities are doing post their earnings. A tough go of it for software companies. Intuit falling 10.2%. Its outlook disappoints. That adds to the pressure that it's already been feeling for this tax advisory company. Meta, we'll get into this too, rising 4%. A Bloomberg report that it has discussed settling its teen addiction case with 29 states. And all eyes this morning on Nvidia, down 1/3%. It's going to be reporting its earnings after the bell. We begin with our top story this morning, though, the latest economic data. And the U.S. consumer spending stalled in July as PCE advanced in line with expectations. Let's break down the latest data with Michael McKee, Bloomberg's international economics and policy correspondent. Mike, what do we see?
Well, we see mixed news, but really it sort of leans in the direction of the hawks for the Fed. PCE headline comes in up 0.2%, more than anticipated, leaves the year-over-year rate at 3.7%. The core at 0.2% is stronger than anticipated. Core stays at 3.3% on an unrounded basis. But go back to that PCE core month over month. It's wrong on the chart there, but in the core is the 2.46, which is 4/100ths below having it revised up to a 0.3, which would have moved everything higher and definitely sent a bad signal to the Federal Reserve. The super core comes in higher. Up to 0.3% for the month. That's ex-housing and ex-energy. So right now, it does look like there is still an inflation issue, and the hawks will be able to make something out of that. You look at the trend in the headline PCE, which is the Fed's official measure, and the question is going to be all the way over on the right-hand side. Yeah, that arrow has come down, or that line has come down a little bit, but look at the distance between that and the 2% target and how much they have to do. And I imagine we are going to hear over the next couple of days, definitely the hawks making the case for thinking about a rate increase. What else did we get? This is where the mixed news comes in. Personal income up strong, 0.4%, because wages and salaries went up in July, but spending dipped a little bit. Now, is that a worry? Durable goods orders, very strong, 1.1%. The business side of spending in GDP was up, and a lot of that was Boeing, but a certain amount of it was cars, as well as some consumer goods. So there is some strength there in terms of manufacturing. The capital goods core up just 0.2, though. So that's the mixed part of it. GDP was not revised. It was 1.5%. However, if you take out inventories and you take out the government spending and you take out trade, things that are not really the consumer side of the economy that you're looking at, you get a much stronger number for what they call real final sales to domestic purchasers. That was up by 4.2% in the second quarter revised. It had come in originally at 3.9%. So we have still a fairly strong consumer, still a fairly strong business spending, and that's a lot of AI stuff. And then we get a little bit stronger inflation. So I think that's why you're seeing yields rise, and people are going to start reconsidering the idea of a Fed rate cut maybe in September.
Mike, how does this set us up for Jackson Hole and what Kevin Warsh needs to communicate to this market?
Well, the new chairman is kind of under pressure from Wall Street to say something about what he would do if inflation doesn't come back down, because he's promised us it's going to, that they're going to get to the 2% target. And investors have been frustrated by the fact that that's kind of all he says. And he parried a question about whether they would raise interest rates if inflation doesn't come down. So there's a lot of hope on Wall Street, a lot of expectation that he'll say something along those lines without promising anything. So no forward guidance. But we're going to have to wait and see how he takes all of this data as well. But those who are on the committee and who are hawkish are probably going to make some noise about today's numbers.
All right, Mike, thank you very much. That is Bloomberg's Michael McKee. And make sure to tune into our Bloomberg surveillance special on Jackson Hole. Mike, I got to know, are you going to be wearing that cowboy hat behind you for the special?
I may, you know, we'll have to check with the powers that be. But
if it's up to you,
Hira
and I think our vote is yes. Please do wear the hat. Mike, thank you very much. Looking forward to your coverage. Now, the countdown is on, and we are just several hours away from Nvidia's results. The earnings will give investors a key read on the state of the AI trade. Let's bring in Bloomberg Tech host Ed Ludlow. Ed, where do expectations stand for later this afternoon?
Yeah, just incredibly high. You know, sales of $92.3 billion, adjusted EPS of $2.09 is double what it was a year ago. And the high bar is probably set against the guide for the third quarter, fiscal third quarter current period, where Wall Street consensus is $105 billion of revenue. So Nvidia joins that kind of smallish club of $100 billion quarterly revenues. You know, it was only in fiscal second quarter of 2024 that this company notched $10 billion of sales in a quarter for the first time. So those are the numbers, right? There's a high bar against them. What we've talked about in recent days is after that run of declines, which matched the streak in September of 2022 that ended yesterday, you know, the stock trades on a performance basis, on a forward PE basis, much more in line with the S&P 500 now. And the market is basically no longer assigning such a premium to Nvidia's future growth. And that's where the question will be. You know, how long does Nvidia dominate the data center build out? Does the data center build out itself last? And talk to us about circular financing.
And moving on to Meta, we know that we have some reporting that Meta and states have discussed settling this teen social media case.
Yep.
How enticing is this for Meta, given that by Meta's own calculations, a trial loss could maybe mean penalties of up to $1.4 trillion, and a settlement could be much less than that?
So, Yahira, the stock's now up almost 5% in pre-market. There was a Bazinga report that Meta has accepted the terms of the settlement offer from those states. Bloomberg has not verified that. What we had reported last night was that there had been talks mid-trial between Meta and those groups of states' attorneys general. The $1.4 trillion potential penalty was calculated by Meta itself. It was Meta saying, if this goes to the worst case scenario, this is the financial stress that we're under. I think the states themselves said that that number was way inflated. The bigger issue probably, and what will be interesting in the details of any settlement, is what operational and technology changes were required. Because the basic accusation is that Meta deliberately designed Facebook and Instagram, other platforms, to encourage compulsive use among young people. So what will they be required to change about those platforms to remedy that? And like that will be a big part of it. But clearly, you know, from de-risking on the stock, that any settlement that removes that potential 1.4 trillion penalty, which again, Meta calculated, Meta's always denied the allegations made against it, it removes a bit of an overhang.
And we'll be sure to bring our audience any update if we are able to match that story. Ed, a good day for Bloomberg Tech. Bloomberg Tech host Ed Ludlow, catch him in just under 2 hours' time on the show. Now, elsewhere in the world of technology, Intuit has kicked off a software stock earnings for the week, and it gave a full-year forecast that underwhelmed. Bloomberg's Ryan Vestelica covers that sector and joins us now from Chicago. Ryan, this is already a deeply beaten-up stock. It's almost halved so far in the past year. Just how much of insult to injury was this latest earnings report?
Yeah, it was pretty bad for the Intuit narrative. We've seen at least 2 analysts downgrade the stock this morning, including Bank of America, which warned that this is a sign that maybe people are going to free AI-related alternatives, which is obviously really the heart of the bear case that has been facing software for several months now. The concern that AI disruption is going to be sort of a long-term headwind to growth, to profit margins, to pricing power, and Intuit really just falls right into the heart of that concern for a lot of investors. Weak outlook, we saw sort of similar results from Zoom, which had sort of another underwhelming forecast. Really, it is just adding to the concerns that people already had.
But more broadly, Ryan, we have seen software stage a bit of a comeback lately. So what does that mean for when Salesforce and CrowdStrike report after the bell today?
Yeah, I think there's going to be even sort of higher expectations for them to deliver and just really show that they are not seeing this sort of same growth risk or disruption narrative. Both of these stocks have really been under pressure. Well, not CrowdStrike, but Salesforce has really been under pressure. It's another one where people are like, this should be pretty well insulated from AI just because of its proprietary data. Just there's all these compliance issues surrounding the CRM software. So people were kind of optimistic, but this is one that's it's been really struggling to find a bottom and enjoy any kind of long-term pronounced rebound. So this is another opportunity for them to help address some of this stuff. But Intuit, I think people are just now a lot more likely to just sell at the first sign of weakness rather than maybe waiting and looking for values and hoping for the longer term story here. CrowdStrike, there is a sort of a narrative surrounding what does AI mean for security? Is there going to be more demand for security? So a lot of the cyber names have been doing very well, including CrowdStrike, but those are also on the higher end of the software sector in terms of their multiple, so maybe a little bit of elevated expectations there.
Hey, Ryan, really appreciate your reporting. We look forward to those earnings results. That's Ryan Vostelica from the Bloomberg team. I do want to mention we're just speaking with Ed about Meta potentially settling their teen social media case. Reporting coming in from Bloomberg that Meta and the states have agreed to settle the teen social media harm case. We're waiting details of just how much that might be. As Yahira mentioned, a potential lawsuit. They could face penalties under $1.5 trillion. This would be less. We are assuming so. So we will wait for the figures of how much they have agreed to settle for. But Meta at a high in the pre-market, up 4.6%. Here's how your other markets are faring this morning. We are still down across the board. We had started to inch higher, but hotter CPI that if you round basically up just a little bit more. It was hotter on the core figure, too. We're down by 0.5% for the NASDAQ as we wait Nvidia earnings. 10-year yields, those move higher. They had been coming in because of the price of oil, but now they're up 2.5 basis points at 465.45 for your 10-year yield. Brent crude, that still declines down 2% as hopes that Oman and Iran maybe have reached some sort of agreement over trafficking the Strait of Hormuz. Let's get a look at some of the other individual movers on our radar this morning. With that is Nora Melinda. Hey, Nora.
Hey, Danny. A few stories I'm keeping on my mind. First up, remember Uncrustables? Well, it turns out that they're still a hit. JM Smucker raising its outlook for the year with Uncrustables and Coffee Bill driving success. Earnings also beating expectations, and the company got about $115 million back in some of those tariff refunds. So you're seeing shares of JM Smucker up by about 5% in the pre-market trade. Now on the flip side, Strategy, though, getting a massive 22% cut to its price target at Bernstein. That's a $350 from $450 a share. The firm does, though, still rate the stock at outperform, but Bitcoin's rally is stalling around that $80,000 mark, and Bernstein lowering its forecast on Bitcoin and expecting even more share dilution. Shares of Strategy down by about 2.4%. And finally, wrapping things up over to solar, UBS upgrading SolarEdge to buy from neutral. The FCC banning imports of new inverter models. The firm thinks that this could mean less competition and more market share for the company. Shares, though, of SolarEdge up by about 6.8%. Those are your morning movers. Danny?
Thank you very much, Nora. Coming up, a fresh batch of retail earnings. We're going to take a look at Kohl's and Abercrombie next. You're watching Open Interest.
Now to high interest, a look at what's making headlines around the world. Iran's military saying it has reached a revenue sharing agreement with Oman on the Strait of Hormuz, sending oil prices lower. The Islamic Revolutionary Guard Corps spokesman also saying the U.S. is obstructing the process and causing delays. Iranian officials have warned that a deal with Oman would not immediately reopen the waterway. Hedge fund billionaire Stanley Druckenmiller admitting to using AI to write an op-ed in the Wall Street Journal criticizing Treasury Secretary Scott Bessent's bond buyback plans. Druckenmiller telling Notice, quote, "Of course I used AI," adding, "I'm not embarrassed by it. I write everything using AI now for the same reason I use a calculator when I do math problems." And a turnaround attempt at Kohl showing some signs of progress after the retailer raised its annual earnings outlook, but it still doesn't see sales growth this year. The outlook came after revenue missed Wall Street estimates last quarter.
Let's get more into that story, Yahira. Joining us now is a man who does not rely on AI for his stories. It is Bloomberg Global Business Managing Editor Craig Trudell. I don't want to get us in the AI rabbit hole. Maybe we should talk about it since you are a leading editor at Bloomberg, and I'm sure you have feelings. But let's start with the retail earnings. Kohl's falling, not the biggest store, but is it any indication of generally how retail is faring right now?
I mean, we saw yesterday with Dick's that, there are absolutely possibilities for retailers to really sort of let down the market. I mean, the degree of decline out of those shares yesterday was really remarkable. With Kohl's, it is absolutely the case that you're seeing a bit of a letdown here. This was a stock that was showing signs of life under a new CEO last year. When he was made permanent in November, you saw a really big pop. We've seen some loss of momentum there. There is, to be fair, a little bit of a bump up in guidance for them in terms of seeing a less substantial decline in sales this year. But he has not managed to get this company on a track for growing again.
Meanwhile, Abercrombie is faring much better. So is this more of a story about not necessarily a weak or strong consumer, but just them being more selective when it comes to what they're purchasing, what stores they want to go into?
Yeah, I mean, I'm interested in the Abercrombie story as someone who was, growing up at a time when it was like at its peak, right?
Yeah.
And it's managed to sort of grow up with us a little bit, right? And sort of appealed to the generation that does remember it fondly, even after the hard times that it fell on for years. It's interesting to see the Abercrombie brand specifically be so strong, and that's really sort of where the company is doing well. Hollister less so, but a significant pop in the shares this morning on the basis of the Abercrombie brand in particular doing nicely.
And they're not like gassing us with their cologne anymore. Like every time we walk by,
They've grown up.
That's certainly a sign of growing up. It's quite sweet, actually. Craig, thank you so much for joining me. Hi, and myself, Craig Trudell, from our Bloomberg News team. Coming up, we're going to bring you more details. They're just breaking now about Meta's settlement with dozens of states regarding a teen addiction case. We have a number around $17 billion. We get the details with Ed coming up after this break. Breaking news, Meta has agreed to a $16.7 billion settlement in its teen social media harm case. The stock is up nearly 4% on the news. Let's bring back Bloomberg Tech host Ed Ludlow. Ed, we were just talking to you moments ago before this. We have a price tag on the settlement. Just how big of a relief, of a savings is this for Meta versus if they had gone to trial?
Well, against what Meta said was its worst case scenario of 1.4 trillion, which would be every single count and accusation met with the most severe penalty, $16.7 billion is low. And so clearly the stock reacting as it is in the last moments of pre-market de-risks. It removes that overhang. But again, it was Meta that had calculated that penalty. The states themselves had said that, whatever the outcome of the trial, where it was an advisory jury and be for the judge to decide, the penalties would get nowhere near that. They would be in the hundreds of billions of dollars potentially. One thing is just against history. You think back to 2019 when Meta settled with the FTC on a privacy issue. That was $5 billion. It's had prior settlements in various pieces of litigations in the low single-digit billions. So this is still a pretty significant number, Danny.
And Ed, the states weren't just asking for money. They were also asking for changes on how Meta operates. So how much of a relief is it on that front as well?
Yeah, I think I'm still searching for details and reading through this court filing. The accusation from the states, it was a mix of consumer protections at the state level and then one federal level privacy law. But the basic accusation is that the platforms were designed in a very specific way to keep children hooked on them. And so whether Meta will be required as part of this settlement to change those platforms, either algorithmically or from a policy perspective, and it will be for the analysts to kind of work out what any tangible impact of those would be. That is a part of the story here, but I'm still searching for that in this court doc.
Yeah, and again, things are quickly changing here. Meta shares, they are up 4%. Ed, as I know you are looking for that in any details. For what it's worth, again, we just have the $16.7 billion figure in this landmark case with multiple U.S. states, 29 of them suing Meta. Meta agreeing to settle, as Ed was mentioning, the high watermark. They said this could be over $1 trillion. And I appreciate this is still not enough time to completely look through the documents. But if we take a step back, I just wonder where this brings us going forward, because we're talking about major technological disruption and maybe an inability of regulators to keep up with it. Social media addiction, a clear one here with Meta. And now we're going to have to grapple with the changes to society that AI is making. What does this case teach us about ability for regulators, for this court system to keep up with the changes that technology are bringing to society and indeed teens and younger people who use it?
These are the questions. So again, I don't yet have in front of me any part of the settlement that is non-financial. In other words, mandatory product or platform change or technology change. The $16.7 billion deal kind of closes what is one enormous case and potential financial overhang on the stock and the company, but not Meta's broader youth safety legal issues. Part of the item with this case and prior litigation that they've been involved in 2026 is that there are a number of potential, thousands of them, personal injury, school district cases that Meta may or may not confront. And so that has been something that analysts have tried to gauge what comes next.
And just seeing now some of this reporting that Meta has agreed to impose daily limits and nighttime blocks for teenage users, bolster its age assurance systems to prevent children from accessing inappropriate content, and provide extra tools for parents and guardians. Ed, I know this is still a developing story. We'll continue to catch up with you and the reporting from the tech team. Ed, thank you very much. Bloomberg Tech's Ed Ludlow. And we are just moments away from your opening bell. Amanda Agati is going to be joining us to discuss what she's watching ahead of Nvidia earnings. You're watching Bloomberg Open Interest. Let's get your trading day started. You are watching Open Interest. I'm Danny Berger. Matt Miller still off, and it is a muted session so far in the pre-market. We'll see if this can turn around, but being weighed down by PCE figures that came in ever so slightly, like to the third decimal point, hotter than expected. Omar Sharif of Inflation Insight says that this means that the Fed may indeed need to hike. Dow futures also unchanged. NASDAQ down 0.4% as we await for Nvidia. Opening bell done at the New York Stock Exchange. Optimal Tax Asset Management, like maybe the most boring name that you could think of, but they offer things like ETFs and mutual funds. And I guess their tax optimization strategy is so boring, but obviously important. Down at the NASDAQ, we have Frequency Electronics that is listed down there. They make components for space ventures, for wireless. They are up only about 11% year to date, so they are underperforming. They are a small cap equity. Some of the stocks that we're watching, we had some earnings after the bell. Intuit specifically down 4.5%. An outlook that was largely disappointing. They've already been under a lot of pressure, as have a lot of software stocks. Meta, we've been breaking this one down for you. A $17 billion settlement with 29 states. States were originally seeking up to $1.4 trillion in penalties. According to Meta, they've also agreed for some remediations, like putting a time cap limit of under 2 hours for teens under 18, also giving parents and other guardians more tools to monitor the usage. So those shares are up 3.4%. Nvidia, that is down 0.2%. It is going to be reporting earnings after the bell in another test for the AI trade. Let's talk more about this and bring in PNC Chief Investment Officer Amanda Agati. Amanda, great to see you. In quarters past, we have seen Nvidia be this big market event, but over the past few quarters, the stock has sold off after it's reported its earnings. What is the bar, not only for Nvidia, but for the entirety of the market, for this earnings report to help carry us and propel growth from here?
Well, Dan, it's always great to be with you. Thanks so much for having me. I'm going to stick with the storyline that I think the consensus is also talking about today. It's all about guidance from here. We all expect the fundamentals to deliver for this quarter. So that's not really the storyline. I think the key questions for pretty much all investors are, what's the path forward for demand growth? Is it broadening beyond just a few customers? What does the inflection point in CapEx look like? Is there one? Or do we just continue to accelerate from here? And really just where are we in terms of innings of the cycle? With the fundamental backdrop, we still think it's early to kind of middle innings. This is not a late cycle story at all here. But I think the guidance is really going to be the most important driver for markets.
And going off of Danny's question, Amanda, if Nvidia delivers another great quarter and the stock fails to rally. What do you think that tells us about the AI trade in this moment?
I think it literally just tells us that valuations are starting to become a headwind, that investors are getting, and again, this is not rocket science, right? But investors are getting a little bit more price sensitive to what they're willing to pay for growth. And I think the thing that I've been talking about all year, and many others have too, is really what return on invested capital is going to look like at these valuation levels. So much spending, hundreds of billions of dollars across the board being spent here, not a lot of return on that invested capital yet. So I think there's still a decent amount of investor skepticism. When you add that to the valuation story, it just creates a little bit of headwind here in the short run. Doesn't mean it's over.
Amanda, I've heard though over and over again, Nvidia is a deal now. It's sold off for 7 straight days. This market's not as frothy as it once was. We had some damage in July. Is that not the case? Are valuations still an issue?
Well, I think valuations have been, quote unquote, an issue for a while, right? Nvidia is not cheap, and it's sort of funny. You're making me giggle to talk about 7 days, right? 7 days is a rounding error. It's literally irrelevant in terms of this secular growth story and this innovation cycle. So I'm not sure that it's moved the needle much in terms of investors clamoring to get a deal here. I think investors need to get a lot more creative about the path forward if they're worried about the last 7 days.
And Amanda, you note that this has been one of the strongest earnings season in years, but fewer than half of companies are being rewarded on earnings day. What does that tell us about how this market grinds higher from here if we don't get those rallies after beats?
Yeah, well, we're 5 quarters in a row now of effectively setting a higher bar, a function of positive revisions over the course of each quarter, and then beating that high bar. And so I think that does make a difference, right? How much momentum is left in the trajectory of growth from here? We are seeing an acceleration in positive revisions for Q3, but it is at a slower pace than what we have seen in past quarters. So still positive, still a higher bar, still a lot of fundamental strength here. But I think this rally is just starting to exhaust itself a little bit. And then when you factor in all of the macro policy uncertainty, the macro backdrop has gotten really complex and really fast, despite this disconnect between how strong earnings growth has been and also the economic growth backdrop. And so I think investors are just sort of feeling like, how do I play this macro backdrop from here? It's starting to put a little bit of the brakes on. It doesn't mean it's the end of the cycle or the rally. That fundamental story is still strong, but I think the macro headwinds are starting to bug investors.
Well, you get headwinds today with CPI that ever so slightly, but indeed still is hotter than expectations. It's pushing yields up across the curve, specifically on the front end. That's up nearly 5 basis points. And then you also have to contend with what the Treasury is doing, trying to move around or move down the long end. That did have maybe some effect. Maybe it was oil that was pushing yields down. But Amanda, it is this back and forth. What is the transmission mechanism for that pressure and volatility in yields and Treasuries to translate over to equities? Or is earnings growth strong enough that you can look through it?
I think in this environment, there's less of a direct correlation between higher yields and what happens to the stock market. It's not a perfect correlation. It's certainly not an inverse correlation, but I think relative to history, we're seeing a little bit of loosening there. So to the extent that the fundamental backdrop continues to be so strong, I think that gives us a little bit of a reprieve. It bails us out a little bit relative to where yields are kind of pushing to, but it's not, again, a perfect correlation. So I do think there is a limit to how far yields can go before the stock market starts to kind of falter a little bit. Again, it all comes back to the fundamentals. That fundamental story is really strong, but as it relates to the Treasury and the Fed, they've got to be working overtime right now. This is not a 9-to-5 gig. That was a Dolly reference. You know I had to get something in there.
Thank you, Amanda.
May she rest in peace, of course, a true legend. But I think from a Treasury and a Fed perspective, this is really hard. The push and pull of trying to analyze the data and figure out what the path forward is for policy and rates and all of that, it's very purple haze in this environment. I don't envy them at all.
And sticking with that, Amanda, on the Fed, we have Kevin Warsh getting ready to make a big speech on Friday. We all have a list of what we want him to say, we want him to tell the market, but what are you actually expecting?
Well, it's a great question. I wish I had a perfect crystal ball answer for you. Notoriously so, Jackson Hole tends to be a market moving event year after year after year. It seems as if whatever comes out of Jackson Hole does tend to move the market in a pretty significant way. I mean, I think the wish that every investor wants is clarity on what they're going to do with the policy rate. I think it's a really hard one to give a lot of clarity on. He himself doesn't want to shed too much light from a forward guidance perspective. I think it's really tough in this environment to raise rates. I know there's a lot of, disagreement on the part of the Fed on what to do, but just given this macro backdrop and how complex it is, I'm not sure that 25 basis points matters at all. I guess that's the good news, bad news for the market. If we raise 25 basis points, it's not the nail in the coffin for the market. But I don't think it solves some of the macro forces in play. There's other things in play here, other exogenous factors that have nothing to do with 25 basis points plus or minus.
Amanda, great to have you on. Thank you so much for joining us. That's PNC's Amanda Agati. The team on the tech team for Bloomberg have been reading through this Meta lawsuit case. We want to bring you the latest that we've learned from it. Again, as a reminder, Meta has agreed to settle with 29 states in a teen social media harm case rather than bringing this fully to trial. The settlement number is $16.7 billion. California will receive up to $2.1 billion in the settlement. New York as a state gets less than that, just over about $1 billion. They've agreed to a 2-hour daily limit for those under 18 years old and will block 12 a.m. to 6 a.m. for those under 18 as well. They are saying for their financials that they will accrue about $10 billion in legal expenses in the third quarter as part of this. It is reaching a pact with 51 states, so all states on this usage. They are also calling TikTok and YouTube to follow their example. Again, Meta settling in a lawsuit for just about $17 billion, avoiding the worst of the penalty, which could be around $1.4 trillion. All right, we are about 10 minutes into your trading day. Let's see how some of the other stocks are shaping up so far this morning. Little changed on this market. We were down more dramatically in the future session, given what CPI did, coming in a little bit more steeply than expected. Microsoft, that is the best performer based on points added, followed by Oracle, AMD, United Health, Apple doing well too, Broadcom. We are awaiting Nvidia earnings, and that is heading slightly lower so far here in the early moments of this trading session, down 0.5%. Healthcare not having the best of day. Eli Lilly is down 3.2%. Meta now logging a decline. It was up after the announcement. Now it is down nearly 1% as they announce that $10 billion hit to their third quarter earnings results. In terms of the individual sectors, energy is the worst performer, or one of the down ones, not the worst performer. It's only down 1/3% as the price of energy falls. Now it's communication services that is the worst because of Meta dragging down the overall index. Discretionary is not doing well. We had Kohl's earnings, those disappointed. Industrials, utilities, materials, those round out the top sectors. Coming up, Vanguard making a major push into wealth management in a deal to buy Altruist. We're going to speak with both CEOs in a broadcast exclusive. That's coming up next. This is Bloomberg. Breaking news earlier this morning, Vanguard is buying digital wealth platform Altruist. The deal marks Vanguard's intensifying push into wealth management. And you might remember Altruist back in February. It sparked a sell-off in wealth management stocks after launching a tool aimed at creating tax strategies. So pleased to say that joining us is Vanguard CEO Salim Ramji and Altruist CEO Jason Wenk in an exclusive interview. Thank you both so much for joining. Jason, do you enjoy the notoriety you still have for making all of your peers sell off? Like this is a really exciting deal. And Salim, if I can start with you, because this is a departure from Vanguard. You're known for growing organically. Why not go that method in expanding into wealth? Why does it make sense for Altruist, who you've already partnered with, to outright buy it?
You know, we've been an investor in Altruist going back more than half a dozen years. So we were a minority investor kind of in the early days when Jason and his team were first getting started. And what we were impressed back then about is what we're also impressed about today. The first piece was really the mission that Jason had founded the firm around, which is making advice more accessible, more affordable, and better for many more Americans. And the second piece, which is really takes us to today, is just the tenacity with which Jason and the team have really been building their business. And from a Vanguard perspective, we want to do for financial advice what we've done for the past 50 years for investments, which is really make it much more accessible to many more people. And part of this alignment around the mission, right? When Jason was talking about the mission of Altruist to me, and we were comparing notes, a lot of what he was trying to do rhymed with what we were trying to do, and I think in that it really led to this moment.
Well, I'm assuming part of the mission has been this fast growth and nimbleness that Altruist has, Jason. I mean, you're in California, you're away from the hub of financial services here in New York. Why not stay independent? Why partner with a behemoth when one of the sort of bright points of Altruist had been, this independent sort of flavor that you had as a firm?
Yeah, I think so. We're probably more alike than people realize. I heard Celine say that Vanguard is not a Wall Street titan. They're a titan of Pennsylvania, rural Pennsylvania. We were founded on Abbot Kinney Boulevard in Venice Beach, California, so also about the anti-Wall Street as you can get. But Altruist is a business that's designed to help independent financial advisors. Those independent advisors are often referred to as RIAs. They serve tens of millions of clients, over $10 trillion in assets. And we're incredibly focused on empowering those advisors to make advice better, more affordable, accessible to everybody. You'll hear a lot of, the rhymes with, the genesis of Altruist in many respects was inspired by Vanguard. I'd been a fan of Jack Bogle's work going back into the late 90s, early 2000s. Our mission is very similar to the Vanguard mission, to take a stand for all investors, right? So you start to see these things. And when you are an entrepreneur and you're thinking about leaving a really long-term legacy, and in our case, it's one of, again, this very mission orientation around making advice better and more affordable and more accessible, there's no better partner I can think of. And again, this would have been likely the case when I started the company 8 years ago than Vanguard.
And you also very much so rhyme with a Fidelity or a Schwab, though, considering your business threats them. I mean, Salim, is this Vanguard becoming even more of a direct competitor with those?
Look, if you think about the problem we're trying to solve, and it's not just Vanguard and Altruist, I think it's many firms, but I'll be particular about what we're trying to solve. It's how do you get more access to financial advice? Today, only 1 in 5 Americans have access to a fee-based financial advisor. We would like to see that number be most Americans having access to financial advice. And even as we surveyed Vanguard's own investors just earlier this summer, what they told us, 74% of them, is they want access to some form of human financial guidance to be able to make sense of all the complexity out there.
Yeah.
And so part of what we're trying to do is use technology to give independent advisors greater scale, greater ways to reach more and more clients, but also use technology to help clients who may just want a second opinion or may just want some basic kind of guidance to be able to get that guidance. Because if you go back to our founding mission about helping improve the chances of people's investment success, having low-cost, high-performing products is one component of it, but another component is financial discipline. And what we've seen over decades is that if you got a good fee-based financial advisor that's focused on your interests, that they can really instill that long-term discipline for an investor. And with technology, we think we can do that with greater scale. So
again, the mission is nice, but it's the business case I'm also interested in. I mean, is this you wrestling market share away from some of those competitors by this with this purchase? Yeah, because of Vanguard's unique structure, we're owned by our clients. We don't necessarily think like traditional companies will. And so is one of the best accomplishments, I think, of Vanguard over the past 50 years. It's 50 years ago this month that we launched the first index fund. And one of the best accomplishments, in my opinion, is that many more people, 2/3 of Americans today, are investors, in part because we help make investing simple and more affordable and more accessible. And what we want to do is do the same thing for advice, because there is a scarcity of advisors and of fee-based advisors, and there's exceptional demand, whether you take my 74%, you take other industry stats, and we think being able to marry kind of the scarcity of supply of great financial advisors with the technology that Jason and his team have built really helps us do for
investors who are seeking advice, what we've done for investors over the past 50 years who just want a low-cost investment product in which to enter the markets.
Well, having like this sort of technology-based IRA custodian, again, I mentioned in February, it led to kind of this panic among some of the more traditional ones. Jason, what have you seen since then? Like, have you been this really disruptive force, or is it more, to the point that Sam Altman made the other week, sometimes these things are slower moving in adoption and really embracing AI in some of these forms?
Well, on AI, I think that there's still a lot more opportunity. I think there's a lot more possibility than reality, today. So I think Sam's probably right in that regard. As for us, I mean, we've had a fantastic year. We're still a young enough company that virtually every quarter is a new record quarter. I think the innovation's a big part of that. And in our case, because we serve advisors, advisors for the last couple of decades have had very few choices. It's hard for them to run businesses. They have to make a lot of compromises. The compromises might be either I can only serve really wealthy people because I don't have enough capacity to serve more, or I have to reduce the quality of work I can do because I want to serve many. A lot of our growth is because we're able to bridge those kind of two conflicts and make it much easier for advisors to do their best work at scale, a lot more clients, a lot higher quality work, and to do it at a lot lower cost. So. These are things that AI is a huge enabler for, and technology in general can help enable.
Just on that, how much of that does it hinge on keeping compute costs low? Because this is something that businesses have also had to grapple with.
For us, it's not been a challenge. So, compute, I think, depending on the type of work, I mean, there are some tasks that are, very compute intensive. Some knowledge work will fall in there, but definitely not an issue thus far, and I don't see that being an issue in the future.
Salim, I have to get into the numbers a little bit. Wall Street Journal, I know, reported that this deal valued Altruist at $4 billion. Is that the right figure?
Yeah, we're not disclosing the financial terms, but what we are really quite in unison about is what do we want the outcomes to be. And one of the outcomes is to enable most investors to have access to some form of financial advice or some form of financial guidance over the coming decade. And because from our perspective, and it's, again, we're a different type of company because we're owned by our investors, that if we can do that and give people access to that in a high quality, low cost way that people have come to expect kind of from our funds, then what we can do is help them maintain financial discipline, and ultimately, we can help them achieve investment success, which is what the company was set up for.
Again, given sort of the rhyming and how much you align on these sorts of things, in your mind, is this sort of a one-off? Because as I mentioned at the start, it is very rare for Vanguard to grow inorganically, to do M&A, or is this kind of maybe you dipping your toe in and this might be the future for Vanguard, looking at adding companies like Altruist that make sense on more frequently?
Yeah, like we're a very discerning buyer, and Jason was a very discerning kind of seller, and I think that there's so many unique circumstances that made this feel right to both of us. Some of it goes back to 2020 and the early investments we made. Some of it was a strong sense of alignment, kind of a mission, and some of it was just based on the very complementary nature of what Altruist does and what Vanguard does. We have a very loyal following amongst RIAs. We've been big supporters of them through kind of our funds, our models, our research, and so does Altruist. And so these are really ways in which we can serve that community better, because we really believe that if we can help that community of fee-based advisors scale what they can do, they can serve more investors, and ultimately, in Vanguard kind of parlance, that's helping us take a stand for all investors and helping us kind of improve their odds of investment success.
I have like just over a minute, but I would love to get both of your your views on prediction markets and sort of the gamification of investment. Is that trend worry you at all, Salim?
Oh, it worries me tremendously. What we're about is long-term investing. And we really see kind of different forms of whether it's sports betting, gambling, and the like, as things that start to cloud between what is investing and what is ultimately speculation. Vanguard has always been about long-term investing. We're always going to be about long-term investing. And even as Jason and I talked about this kind of in some of our early days, there are very similar views that you had held. kind of around just the bad outcomes for investors if you start blurring these lines.
Yeah, I mean, look, we have something at Altruist we call the sacred rule, which is that we will never build something that harms investors. And so I've been a very outspoken critic of prediction markets. I think they're a terrible idea for most people, and I think they don't belong in financial services applications.
Maybe a good way to get young clients, though.
If you don't want them to have money in their future, it's probably a good idea. But again, I think if we focus on like empirical, evidence-based ways to help people achieve their long-term goals, this is partly why we focus with serving these independent fiduciary advisors. It's so critical that advisors help coach people along. Look, there may be things that are okay to do, it's for fun, and then there's things that they shouldn't do, and that these advisors play a huge role in making sure that people are on the right path.
Thank you both so much for joining. Again, congratulations, Vanguard and Altruist.
Thank you. Thanks, Danny.
We are 30 minutes into your trading day. Welcome to Bloomberg Open Interest. I'm Danny Berger, alongside Yahira Anand, and it is an equity market just barely pushing into the green. And coming up, we discuss that. Stocks are wavering as fresh eco data does little to alter bets on the Fed's next move. Meanwhile, Nvidia CEO Jensen Huang takes the spotlight as investors look for the next signal on the AI boom. And Meta agrees to a landmark settlement over claims Facebook and Instagram fuel teen addiction. We begin with the latest economic data. Consumer spending stalled in July, while a key inflation gauge rose as expected, but slightly hotter if you take it out to the third decimal point. The Fed, maybe it gives them more room to hold rates steady, but let's get to Michael McKee, Bloomberg's international economics and policy correspondent. And Mike, I just say that with skepticism because I was looking at an Omar Sharif note that basically said this data might mean the Fed needs to hike. What did we see?
I've gotten several notes, Danny, that also say this data means the Fed doesn't have to hike. So that's going to be the interesting question going forward. We did have a lot of data this morning, and if you break it down into just the numbers that are going to matter for the central bank, headline PCE stayed unchanged, and core PCE stayed unchanged for the year, which does align with the Hawks' view that they've got to do more to bring down inflation because it's been well above the 2% target for more than 5 years now. Personal spending dropped off a little bit. Maybe the economy is slowing. Well, the revision to second quarter GDP pushed real final sales to domestic purchasers up to 4.2%. Now, that's important because that takes out inventories and trade and government spending and just gives you a picture of what business and consumer spending is like, and it was very strong in the second quarter, and that appears to be carrying over, at least in the durable goods areas, into the third quarter. Capital goods shipments for the month of July up 2%. And that'll go into GDP as a fairly strong contribution. So right now, it looks like the economy is still performing well and inflation is unchanged. So to pick your fighter here, either you're a dove or a hawk, and both sides can probably make a claim. And we'll be listening for people here at Jackson Hole for opinions throughout the week.
Exactly, Mike. So does that combination of sticky inflation and weaker spending that you described put Fed Chair Kevin Warsh in an uncomfortable position on Friday when he makes his speech?
Well, if he goes by what Kevin Warsh usually goes by, which is no forward guidance and not a lot of information anyway, it probably wouldn't put him in an uncomfortable position because he doesn't want to comment on the current economy. But Wall Street is expecting him to, at least to the extent of saying something like, well, if inflation doesn't come down, as I have promised, we will use all our available tools to attack it. That may be the most we get out of him, but it'll be interesting to see the market reaction if he doesn't even go that far.
Mike, thank you very much. That's Bloomberg's Michael McKee. And tune into our Bloomberg Surveillance Jackson Hole special on Friday. We'll be drumbeating to the Fed Chair Kevin Warsh's keynote address. That coverage begins at 9 a.m. New York time. Yields are moving higher this morning, led by the front end after that inflation data. But key market metrics have been showing that maybe Treasury Secretary Scott Bessent's plan to expand bond buybacks is making a market impact. Treasuries have outperformed equivalent maturity swaps, narrowing the 30-year spread between the two since the smallest since July. Joining us now is Katy Kaminski, Chief Research Strategist at AlphaSimplex. And Katy, we did see yields come in a decent amount yesterday, their biggest decline in 2 months. They fell to their lowest level in about 3 weeks. Yes, they're moving higher today. But are we witnessing something of a Treasury Secretary Bessent put on this market?
Oh, that's a good question. I'd say for me, this is a week to talk about Treasury yields, obviously, with Jackson Hole. But from my perspective in the cross-asset space, I'd say that the moves in oil had the bigger impact on yields this week. And the fact that we're repricing geopolitical risk, maybe Bessent is a part of that as well. But I would definitely say that it's been much more of an inflation-driven narrative, which means that we need to look at long-term rates and see how they're repricing as oil prices move as the key indicator.
And speaking of long-term rates, Katy, are treasuries at this level attractive enough for you to step in?
There has been flow, and I'd say that at these type of levels, if you look at the one-year chart for most Treasury yields, they are attractive and they are potentially, at a level where you're going to see some buying pressure. And I think that may also add to some of the direction that we've seen this month. I mean, at these type of levels, should we see geopolitical risk reduce and also a narrative where the Fed has room to sort of pivot at some point towards lower rates some point in the future, that could make yields go down and mean that this was a good buying opportunity for many investors.
Katy, there has been, including reporting from the New York Times, a desire from this Fed chair to really communicate to the market that he is serious about taming inflation. It didn't work in his last press conference. There were questions as to whether he would really do that and have the ability or want to indeed raise rates. What would it take from this market to get that message from Kevin Warsh? And would that have the impact of lowering long-term rates, something that, again, the Treasury is trying to do right now?
I mean, I think that is a much more extreme scenario right now. I think it's much more likely that we're sitting in a situation where we're on hold or we're patient. But I do agree that those comments about potentially trying to tame inflation, given the fact that inflation is above target consistently, and we see it above target again today, it suggests that at some point there may be some support for action. But right now, there's just really not enough ammunition for that type of move, I'd say, even though some people would push for it and some would push against it.
And Katy, if Kevin Warsh doesn't give the market the clarity that they want to see at that point at Jackson Hole, how ugly could things get in the bond market? I'm hearing from B of A, they're saying that the 30-year could get to levels of 5.5%. What do you think?
Well, I mean, I think that's a pretty big move, but I will say that trend signals in general on yields have been short fixed income. So there is momentum for bond selling. And I think that suggests that, if the market does get concerned, there could be opportunities out there or periods where people really think that, inflation is going to have a bigger impact. I think I'm not feeling that that's as likely right now, because for us, that has been much more driven by geopolitical risk than monetary policy. So I'd say, I think some sell-off could occur, but an extreme sell-off would require extreme circumstances.
So if this is a bond market, Katy, to go to where we began, that more has been driven about the price of oil coming in, and that's been aiding it. What about this equity market? To what degree is it still being moved by geopolitical risk premiums and, I guess, relatedly, what yields are doing?
So in our perspective, we've actually seen that the equity market has generally shrugged off a lot of geopolitical risk outside of, sort of the initial reaction. There seems to be some connection to risk on. For example, we saw that this week. But let me highlight that when you saw a massive move in oil, you only saw a small rally in equities. This suggests that the impact of geopolitical risk has been largely ignored in the short term by equities, whereas I feel that, you really need to watch the bond market more directly, because that mechanism is much tighter. So you're seeing a much stronger relationship, both in correlation and moves between bond markets and policy response to oil prices, as opposed to equities, which seem to be focused on AI.
Well, then at what point do higher oil prices or higher rates start to impact the equity market, Katy?
This is actually a very important and hard question. And the reason for this is that I see the impact on growth of higher oil prices as a much more second order, long-term effect that's harder to measure initially. So I'd say that we need to see a lot more complex evidence to understand how that transfers into growth. And so that's perhaps why the equity markets have discounted some of the moves in geopolitical risk, because they're not so far seeing the direct impact on growth and earnings that you see. As it's clear, when oil prices are higher, inflation is likely higher, thus bonds are directly impacted by inflation itself. So I'd say, we need to see a much more complex picture to see how growth might actually be affected.
And meanwhile, for this equity market, Katy, as you and the team of quants, I'm sure, know very well at AlphaSimplex, it's been a complicated year for momentum with the whipsaw with the AI trade. We're going to be getting Nvidia earnings after the bell. How is this market set up for those results? Again, just given the back and forth we have seen and the change in leadership, even just within the tech complex itself.
Well, this is a good point, because you're right. It has been very tricky to trade single name momentum this year, because you've seen a lot of whipsaws, a lot of rotations, a lot of sort of broadening of leadership in the equity space that has caused some shifting around for equity positioning. So this is because obviously the AI narrative has been very narrow as it's attempted to broaden and adjust. It has big impacts because it is quite narrow. So I think that's why today is a very interesting day for those type of trades, because it's really Nvidia that is the test case for how is the AI narrative really continuing, and is it going to cause disruptions to some of this positioning that many investors have across a wider range of equities?
Katy, we really appreciate your thoughts this morning. Thank you so much for joining us, Katy Kaminski of AlphaSimplex. Let's get a check on your equity market. We are 40 minutes into your trading day, and now we're basically unchanged for both the S&P and the NASDAQ. It's gone back and forth. At first, it was moving lower because of the pressure of higher yields, because of CPI, but we have a lot to play for today. We still have Nvidia earnings to get through after the market closed, but yields are holding on to their climb higher as the price of bond falls. We're at 466 on your 10-year yield, and Brent crude now under $88 a barrel. Various reporting on Oman and Iran having some sort of agreement when it comes to the Strait of Hormuz. That's helping oil take a leg lower, down 1.33%. Let's look at some of the single name movers this morning. With that is Nora Melinda. Hey, Nora.
Hey, Danny. Well, you mentioned it. The big one we're keeping our eyes on this afternoon. Traders awaiting Nvidia earnings coming out after the closing bell today. These results will give investors a key read on the state of that artificial intelligence trade. Shares of Nvidia lower right now by 0.6%. Now turning to retail, Kohl is delivering a mixed earnings report. The company is seeing a meaningful earnings beat driven by tariff refunds, but also softer than expected sales. Shares of Kohl's lower by 1.1%. Now, it's a different story for Abercrombie & Fitch, though. Shares are on the rise. That's after its second quarter results and profit outlook beat expectations. The retailer is really seeing growth in its flagship brand and increased momentum in the Americas. Shares currently heading for their best day since November. The stock up by about 32%. Those are your morning movers. Danny?
Nora, thank you very much. Coming up, we get back to the breaking news of the other hour. Meta agreeing to pay $16.7 billion to settle a landmark social media case with U.S. states. We'll have that story coming up next. This is Open Interest.
Now to high interest, a look at what's making headlines around the world. Mark Waller's TWG Global is pushing back against fraud allegations, saying it is not looking to sell sports assets at fire sale prices. The firm adding in a statement that the LA Dodgers team is not for sale and it is not considering exiting its stake in the Cadillac Formula One team. Victory Capital agreed to buy First Eagle Investments for $7 billion in cash and equity. The transaction is part of a wave of consolidation in the asset management industry. Elsewhere, Vanguard is buying digital wealth platform Altruist. The deal marks Vanguard's intensifying push into wealth management. And Meta agreeing to pay $16.7 billion to settle a landmark social media case with multiple U.S. states. According to a court filing, the deal requires the company to put new guardrails on its platforms, including restricting how much time youths can scroll and preventing them from switching off certain safety settings without parental consent.
Yeah, Hira, let's bring in Bloomberg Intelligence Head of Global Tech Coverage, Mandeep Singh, on this story. Mandeep, what is your view in what Meta agreed to, both the remedial action, the new guardrails are promised, and the dollar figures?
Yeah, the dollar figures, I mean, they are not that big of a deal for a company that generates, over $50 billion in free cash flow, minus all the data center investments it's doing now. But it's really the overarching theme here is they want to limit usage of social media by teens. That's really what I think every jurisdiction is after. And the fact that these companies had to settle is an acknowledgement that, they agree that, there is certainly an impact. And to my mind, they also have YouTube and TikTok also now kind of joining in that in some ways. So all of them have to implement parental controls and limit usage to certain number of minutes a day, and I think build controls that they should have done on their own, but now they are being forced to do that with the settlement.
And does the increase in regulation, does that present a material threat to Meta that you could see, like sort of cascading?
Well, so it comes down to, how effective those controls are. Look, there's one thing to have parental controls, but how effectively it kind of shows up in terms of engagement. There's no doubt that in terms of user growth, these platforms have saturated. Even when you look at Meta's user growth, every earnings now, they're not growing users, especially in mature markets. So from that perspective, if you take out that under 18 age group, then that will have an impact around usage and ad impressions that they're serving on the platform. And even though it's not the kind of the biggest demographic that they serve in terms of ads, but still, I mean, the power of these platforms comes from engagement and time spent. So if you're limiting time spent, that will have a bearing on, the quarter and how it's perceived in terms of the engagement and impressions growth.
So I'm just looking through some of the things they have to do to comply to this. To your point, limiting time, better age verification tools, restricting things like viewing the number of likes on a post or beauty filters, access to those gets restricted again. What I'm not seeing are things like making sure this algorithm is robust enough that it's not serving them content that is detrimental to their health. Things that might make them feel worse about the way they look or how they feel and that sort of thing. I mean, this is obviously the algorithm is deeply important to keep people scrolling on Reels or TikTok or whatever. Are you surprised that again, doesn't seem to be part of this, what they're actually serving them in terms of content?
I mean, it's hard to come up with a regulation around that, right? How do you figure out, what is Meta's algorithm and will it change or not change? Remember, these companies change their algorithms constantly. Google has changed its algorithm so many times. So, and the thing I think to kind of focus on here is, we're talking about this age of AI where, there is a lot that you can glean in terms of user behavior, and obviously that's how they're showing the recommendations. Why can't they be more effective in terms of implementing controls with the help of AI? And again, it's hard for regulators to kind of offer that as remedies because things change constantly for these companies. But that's where I think they could be spending a lot of their AI efforts in terms of implementing these controls.
I looked, and there are more than 3,000 lawsuits in this broader wave of litigation. So how high is this on your risk list for Meta? At the same time, obviously, they're spending enormous amounts on AI infrastructure, the payoff of that. But how big is this sliver? How high is it on your risk list for the company?
I mean, the fact that they have settled this early, I think it's a good sign, because the longer it had dragged on, and we were talking big numbers, $1 trillion numbers, so this is still a very good settlement from that standpoint. And as long as, there is no breakup risk or anything like that, these companies should be okay. But at the end of the day, it's the regulators who have to decide, are these companies implementing the remedies in an effective way? And if that doesn't happen, that's where the risk grows.
I just can't help but think, I mean, this is like decades since the creation of social media that we're getting a court case about this. And now we have to grapple with AI. Again, it took decades for social media, and I wonder if there's this idea in the community, Mandeep, that like, okay, we learned from the mistakes of social media, that we weren't out front enough in preventing things like teen harm. Maybe AI will act quicker. I mean, maybe that's optimistic. But how are we viewing this in the light of the new technology that's disrupting things now?
Yeah, look, I mean, when I look at social media, I don't think there will be any new entrant now, given all the focus on, regulation and all these things that are being implemented now across these platforms. Imagine if you're a startup, and we didn't have any new social media platforms, the ones that came about, Blue Sky, and they haven't really taken off in a big way. So from that perspective, the more regulations you have, chances are you will not have any new platforms, and that actually increases the power of these platforms. So even though they're settling, they're paying a fine, but the bar is getting higher and higher in terms of things you need to kind of create a new social media platform.
Interesting, Mandeep. Thank you so much for joining us. Appreciate you. Mandeep Singh of our Bloomberg Intelligence team. Still ahead, we're going to get to retail earnings, and it's been a mixed bag. We're going to look at Kohl's, Abercrombie. That's coming up next. This is Open Interest. You are watching Open Interest. Let's get a check on your equity market. Nearly an hour into your trading day, and we're back into declines, down 0.25% for the NASDAQ. Look, this can surely change after we get Nvidia earnings, so I don't know, not a lot of action today because of that probably. And we have Jackson Hole kicking off. We're going to hear from Chair Warsh. So not huge bets being put on. And need I remind you that we're in the middle of the summer when volume tends to be a bit lighter, but a lot is going on. This had been supporting the market, at least it did yesterday. Brent crude coming down with optimism that we could get traffic restarting in the Strait of Hormuz. That's not doing enough, though, to bring down yields with it. The 2-year leading declines in this bond market. Yields are up by nearly 5 basis points after CPI figure that on the surface came in in line with core. But if you take it out to the third decimal point, it did look hotter. Nvidia, those shares are down 1%. Meta, this has been flipping back before gains and losses as they settle with the states over their teen harm lawsuit. $17 billion, just thereabout, is how much they're paying into it. Zoom, both of them reporting earnings. Disappointment, and they've already been under all this pressure because of AI, specifically into it. Kohl's, those shares up slightly, 0.06%, and Abercrombie up 32% after their earnings. So optimism that they are coming back and able to capture the shopper. Coming up, we're going to talk about pickleball. CityPickle hosting Major League Pickleball finals this weekend. We talked to the sport's co-CEO, Mary Cannon. Retail in focus this morning with earnings out. Kohl's raising their profit outlook, but sales remain under pressure. Meanwhile, Abercrombie and Fitch regaining some momentum after posting a revenue beat. Let's get more with Bloomberg Intelligence senior analyst Mary Ross-Gilbert. I got to start with Abercrombie and Fitch, just considering what the share prices are doing, up 30% more than that. What's been fueling them? This very nostalgic brand, I guess, coming back.
Yes, so what you're seeing is that the namesake brand, the Abercrombie and Fitch brand, their total sales were up 8% in the quarter. The comp gain was up 4%. So it was really nice to see a turnaround in their comparable stores, their comparable sales gains. They also had strength in Americas, but they also saw good gains, across all regions, really. And they're seeing, good traction in the third quarter with the denim business. And with Hollister, too, we should start to see those comps improve. Of course, in this quarter, they were down 3% on a comp basis, but that's because they were cycling a double-digit sales increase in the prior year. So it looks like things are back. Now, with regard to the profitability, they are benefiting from a tariff refund. So if you strip it out, yes, their earnings still beat, and that's encouraging.
Mary, and when it comes to Kohl's, obviously this is a company in the midst of a turnaround. They hire a new CEO. They're trying to entice shoppers by having Sephora stores in their department stores. What isn't working at Kohl's, though? I will say we are seeing shares up 1% now.
Yeah, well, so with Kohl's, there could be some technicality with the shares, right? Because you always have short interest involved in the stock. But so you do see a lot of volatility and movement there. Visiting the stores, I just visited a store yesterday, and I have to say that I saw the biggest improvement in terms of the merchandising and also the level of value across the store. You could see that they were much deeper in private brands, which is sort of that entry level, but they were also highly promotional. Almost the entire store was on promotion, and I would say about 20 to 25% of the store was on clearance. So I think there was a lot of value there, so that could be encouraging for the third quarter. Now, look, we're cycling 3 years of stacked declines in the second quarter of almost 14%, and they still delivered a 1% decline in comp sales. So what that tells you is that, look, it's a really competitive environment out there, and off-price is taking share. And so while they're seeing traction in different categories at various times, and as you brought up with Sephora, comps were down 4%, not something you want to see. As the brand was building, as they were bringing Sephora into stores and adding new brands, then you saw better trends. But since then, the business has matured, and if anything, they're being challenged to really sustain comparable gains there. So they still have a ways to go before we really see a turnaround here. What we need to see is some stabilization and that they can hold that.
Mary, appreciate it. That's Mary Ross-Gilbert of Bloomberg Intelligence. Now, there is another consumer craze that's serving up plenty of growth, pickleball. Shout out to the producers for that great pun. This week, CityPickle hosts Major League Pickleball Championship Finals at the Woolman Rink in Central Park. CityPickle has been growing substantially this year, opening a flagship location in Times Square and another in Boca Raton, Florida, to serve more than 190,000 customers through its app. Here to discuss CityPickle is co-founder and co-CEO Mary Cannon. Mary, great to have you on.
Thank you for having me, ladies.
And I say pickleball just dominates my life because every time I talk to my mom, she is talking about pickleball. She's a fanatic and mean on the courts. She is an absolute beast. So I am super aware of the sport, and it feels like it's everywhere. I wonder, in your mind, what is the saturation point right now? Is there a lot of growth left to come for pickleball?
For sure, because you haven't played.
Well, I have with my mom, to be very clear.
But
she forces me to, but...
When in New York, when I ask people, have you played pickleball? People can be sheepish, and they don't want to admit no, but the majority have not played yet. It is interesting, depending on your tracking metric, approximately 50 million Americans are playing pickleball. That actually now surpasses tennis. The participation enthusiasm for the sport is, unbelievable, and yet there's a lot of unmet demand still.
And so are there certain demographics that you're targeting or you see as growth areas?
That is actually, I think, speaks to the popularity of the sport, is that pickleball really is for everyone. We say, sort of in a slogan-y way, it's for everyone 8 to 88, but it's true. We do summer camps, after-school academy for children, and we have players. It appeals to men and women, all ages, including your mom, who I'm sure is fierce on a pickleball court.
And she, for what it's worth, she also makes her grandson, my nephew, play, who is 3 years old. So maybe you need to lower that age group from 3 to 88.
Particularly athletic.
Right, exactly. I find your background is also so financing, so interesting. Financial background, whether it be in real estate with Goldman Sachs or with private equity firm Charles Bank or with Starwood itself. How do you think about the real estate part of pickleball? Because one of the joys of the sport is you can kind of play it anywhere. You don't need that much space, and you can find free spaces to play it.
That's exactly right. The accessibility is what's fueling the sport. Because if you live in many places in the United States, you can spend $100 on Amazon and get pretty much everything you need. You can tape, put a tape cord in your cul-de-sac. You can go down to your local underused, municipal tennis court and play. And so that is why there's 50 million.
But isn't that a threat too?
Well, no. So we were very mindful in naming our company CityPickle because we are good at navigating barriers to entry. For example, our flagship location in Times Square is on the 8th floor of a Class A office building. And I do think that my experience in real estate and in navigating my partner, Erica Desai, and I think are quite adept at navigating the complexity around putting 14 courts in the middle of Central Park, a flagship in Times Square. We're going to be doing our 4th season in Philadelphia in front of Philadelphia City Hall opening next week. So, you know, it's a little harder to play in a dense urban area, and that is what our focus is.
There was a fascinating article on Bloomberg last week about how people are spending a lot of their budgets on hobbies, even as they cut back everywhere else. Is that something that you're seeing? How are you reading the strength of the consumer when it comes to their hobbies like this one?
We are seeing that for sure. We have over 190,000 customers, and I think there's a shortage right now of fun in our country. People have real digital fatigue. It's hard because of AI. It almost builds a distrust on anything on a screen, and people just want to have fun and connect in real time, in real space, with whether it's your family, your mom. I like to play with my teenagers and my family. It can be your coworkers. You know that we have hosted over 3,000 events since inception at CityPickle, and most of them are actually corporate events. So pickleball is a really non-intimidating way to spend time with your coworkers. It's the new golf. Golf can be, my husband, who loves golf, it takes a lot of time. It can be intimidating. Pickleball, you know, solves for that.
I have to say, private equity has been incredibly interested in a lot of niche sports, and pickleball included. Apollo, for example, has been trying to do a roll-up of various pickleball ventures. What do you think of the involvement of that in the sport? Does it help mature the sport, or is there a risk it takes, I don't know, the fun away, as people love to complain about private equity?
I'm a big fan of what Apollo did. I think they're visionaries in the space, and Pickleball Inc. Sort of integrating different aspects of the industry is very smart. We have Avenue Sports Fund is our minority investor for the last 2 years. They've been a great partner, but I think that they're being savvy because they understand that people want to put down the phone, in our case, pick up the paddle. And there's fatigue coming out of COVID. You know, you can't replicate for relationship building, particularly in the corporate world, but anywhere. You can't, you know, beat one-on-one time. And then if you throw a fun activity like pickleball into the mix, it's that much more effective.
And just going off of what Danny said, obviously, as you grow, it becomes more capital intensive. Do you expect to need any more outside capital in order to fuel that growth that you're looking for?
Sure. Again, building a pickleball court, the beauty is it's not that expensive. It's navigating the opportunity in the real estate to put those courts in. We consider ourselves an entertainment company as well. In December, we made a really significant hire, a new COO who had previously been the chief food and beverage officer at Tao Group. And she helped grow Tao into that hospitality, you know, giant that it is. And so we really think of ourselves also as a hospitality company. So you can come, you can, you know, have a beer after you play, you can have a meal with your family. So I think that there's much more growth in the hospitality aspect as well.
Where's your favorite court you have? Do you have one?
Well, it's also, that's sort of like admitting who your favorite child is. But I have to say, today, my favorite court is in Times Square. I actually just came from Times Square, where we put in the first ever outdoor professional court in the middle of Times Square for the next 5 days. Anybody in the public can come and play for free. And it's a big week. I don't know if you've heard, ladies, but it's a big week of pickleball in New York City because we have our activation there. It's so much fun. We did it in partnership with Times Square Alliance, and it's really to celebrate the fact that pickleball is America's fastest growing sport, and it's so accessible to all. But also, the Major League, did you know that there's Major League Pickleball?
Yes, well, we do.
Now we know.
Yes, now we know for certain. But you're competing with the U.S. Open to some degree, aren't you? Does that kind of cannibalize
we
eyeballs?
talked about this. Racket sports growth is good for everyone. And it's not an either or. I think that they complement each other well. That was part of the strategy. But at CityPickle in Woolman Rink in Central Park, we are hosting the championship of 3-day finals of Major League Pickleball. And the popularity of Major League Pickleball, I think, also is a testament to this sport has really captured our country's attention. It's really fun.
Well, I know where I'm bringing my mom when she comes to visit next.
Call me.
Mary, thank you so much. I appreciate it. That is the CityPickle co-founder and co-CEO, Mary Cannon. All right, let's get a check on your equity market this morning. Just over an hour into your trading day, and we're back negative. NASDAQ down 1/10. 10-year yields, those pick up after inflation data, up nearly 3 basis points as Brent crude falls by 1%. Let's look at some of the individual movers. With that is Nora. Hey, Nora.
Hey, Danny, first up, let's look at Bath & Body Works. The turnaround may finally be getting a little bit of traction. Sales beating estimates and the company improving its guide for the year, but it's still trying to win back some of those shoppers who've moved on to places like Sephora. Shares, though, of Bath & Body Works higher by about 4%. Next up, over to software. Intuit giving investors a lot to chew on this morning. Growth is slowing at QuickBooks and TurboTax. Then there's the big question of what AI means for the business. The stock, though, getting downgrades at both JP Morgan and Bank of America this morning. Shares of Intuit down by 4.4%. And finally, wrapping things up, over to Zoom. Its sales outlook basically meeting expectations, but investors were wanting even more, especially with Zoom trying to become more than just a video calling company. Shares, though, of Zoom down by about 6.5%. Those are your morning movers. Danny?
Nora, thank you very much. Coming up, Mizuho analyst Rijay Rakesh breaks down what he expects from Nvidia after the bell. That's up next. This is Open Interest. Investors are awaiting results from the most valuable company in the world. Nvidia results will give investors a gauge into the state of AI and its industry's massive data center expansion. Joining us now is Vijay Rakesh, Mizuho Securities Semiconductors and Automotive Tech Senior Analyst. He has an outperform rating on Nvidia with a $300 price target. Vijay, let's just start generally. What are you expecting from Nvidia after the close today?
Yeah, thanks for having me on, Danny. As you look at Nvidia, obviously, Street is looking for about $92 billion on the quarter and $105 billion on the guide. But we think the numbers will come in much stronger than that. But that said, I think the focus will be more on what they talk about for next year in terms of AI spend, AI capex. I think Street numbers consensus is somewhere around $550 billion for them for AI revenues for next year. But obviously, in the last 2 weeks, they have signed up, they put together a $500 billion financing vehicle with Blackstone Apollo. And also, we think SpaceX, post their IPO, is talking about a 10 gigawatt ramp next year on data center. Just those two combined could be another 500 billion in AI revenue. So the focus will be on what AI revenues look like. So you're already seeing much bigger upside versus where Street is for next year. And also, obviously, you have their next big product ramp here, Rubin, coming up. And Rubin, as they've noted, is almost 10 times the performance of the prior Blackwell. And so all those could be significant tailwinds for them on their earnings call. So.
Hi, Vijay. How closely will you be watching margins given the soaring cost of memory that we've been reporting on for the past year?
Yeah, definitely. I think that is one of the challenges for all the accelerators because memory is so important to the whole training inferencing stack. And so, memory continues to be tight. Memory continues to be undersupplied. But that said, what we have also highlighted in the last in a couple of weeks here is that there is some sort of a de-speccing going on the Nvidia roadmap on Vera Rubin. They're trying to optimize the amount of memory that's on the GPU. So that way, they don't have to take on the full major price increase and the content increase on top of that. So you are seeing some trade-off between slightly lowering the memory content, which should help them actually ship a lot more GPUs and ASICs, might be 20-25% more GPUs and ASICs. So that should be a very nice tailwind for Nvidia as you look at increased GPU ASIC shipments with slightly lower memory. But that said, we think even for the memory guys, what you're going to see is aggregate DRAM demand, aggregate memory demand continues to move up. So you could have a little bit of a Goldilocks on both sides.
Vijay, we also learned yesterday that OpenAI claims that its new chip, Jalapeno, can outperform Nvidia. It said that it's run tests on the processors, and that's what the results have shown them. To what degree is competition a true threat for Nvidia?
I think Nvidia is still the gold standard out there. I think Nvidia is still the tip of the spear. They drive the performance benchmark, whether it's training or inferencing. But what you see is across the industry, there is a need for an ASIC roadmap as well, where the hyperscalers and the neoclouds and the Anthropics and the OpenAIs are trying to have some control on an internal ASIC development, internal ASIC hardware, which is much more aligned, much more tuned, much more synchronized to their own software stack. So you are going to see a little bit of a partition, some allocation to where the CSPs and the neoclouds allocate capex to the NVIDIA GPUs, but also some commitment to their internal hardware roadmap too, which they can control and might be optimized to their software stack. So you're going to see both, but it is almost indisputable. It's pretty much if you look at NVIDIA, they continue to dominate that space. They are the leader in terms of training inference. They set the benchmarks there. So,
Vijay, we're going to have to leave it there. Thank you so much for joining us. That's Vijay Rakesh of Mizuho ahead of NVIDIA earnings after the bell. Coming up on the show, Iran and Oman make progress on reopening the Strait of Hormuz, sending oil lower, down by nearly 1%. This is Bloomberg Open Interest. Brent moves lower this morning as Iran and Oman make progress on the Strait of Hormuz. Iran says the two countries have reached a deal to share revenue from the key waterway as they work towards reopening it. Let's get the latest from Bloomberg Washington correspondent Tyler Kendall. Tyler, what do we know about this agreement?
Well, Danny, it's interesting because the IRGC statement via Iranian state media does go further than the joint statement that we got from Iran and Oman's foreign ministries, which did not say that this was finalized yet and did not mention yet what a fee structure would look like, though we do know that the sides have been actively working on some sort of agreement. Regardless on where it comes down, Iranian officials have made very clear that such an agreement between Iran and Oman would not equate to a full reopening of the Strait of Hormuz until the U.S. complies with Iran's demands, including lifting the naval blockade in order for the strait to be open. We have gotten no signal that is something that the White House is prepared to do, instead touting the success of its blockade, as satellite imagery analyzed by Bloomberg News does show that it's been working, that oil shipments to Asian countries from Iran have all but dried up amid the success of the naval blockade. And if anything, we're actually seeing escalation in the other direction when it comes to the U.S. Yesterday, President Trump posting on Truth Social a threat regarding mines, saying the U.S. would take military action if Iran lays any additional mines in the Strait of Hormuz. Danny, that is something to keep our eyes on, because our understanding has been that as the two sides work to try to reopen the strait, one of the options is to utilize that so-called middle passage, not the passage that gets closer to Iran or the one that gets closer to Oman. But some of the biggest questions there is whether or not there are still mines that could disrupt commercial shipping.
And Tyler, switching over to the trade spat between Canada and the U.S. On top of the tariffs already imposed on Canada, we're learning that the White House is now considering another round of penalties. What could those actually look like?
Well, Yahira, that is perhaps the biggest question at the moment. People familiar with the matter are telling us here at Bloomberg News that the White House is looking at different options, different sort of trade actions, including the potential for higher levies. This would be in addition to the already threatened 50% tariff on auto and auto parts that the president says he wants to put into effect by January 1st. Those auto levies would target the Canadian province of Ontario in particular, which is where we see steel and auto production heavily concentrated. The premier there, Doug Ford, joined us yesterday on Balance of Power, and he's previously spoken about cutting electricity exports to the U.S. as we continue to see this tit-for-tat escalation. All of this, of course, coming after Canadian Prime Minister Mark Carney did make good on his threat to go dollar for dollar in the counter tariffs to the tune of $20 billion. It's definitely something we're going to have to keep monitoring.
Tyler, thank you very much. That's Bloomberg's Tyler Kendall. And Naira, thank you for joining me today.
Thank you for having me.
I'm excited to have you for the rest of the week.
Looking forward to tomorrow.
It's going to be a good 2 days. And by the way, you're not done with me yet. I will be back for Bloomberg Deals, 12 p.m. New York time. I'll be speaking with Jason Greenberg, Executive Chair of TMT Investment Banking at Jefferies. That does it for Open Interest. This is Bloomberg.